Hello everyone and welcome back to my channel. It's been a long time since I made videos on PG subjects. Now again due to lockdown and we are back here. Well, the situation is very bad. We have lost a lot of people. Now we hope that this may also pass as hope is the most exciting thing there is in the life. I'm Suman and today I'll be talking about investment analysis and portfolio management, the subject for MCOM second semester as per Rani Channamma University, Belagavi. I've already talked about the syllabus in my previous video. So today we will start with the first unit, investment management, and session 1 for the first unit. Well, studying this subject is important not just for examination purpose but for general awareness or general use as well, especially in unforeseen situations like this pandemic where people are losing jobs and suffering to earn their bread. And as per a report by Mint, the data given by the Center for Monitoring Indian Economy, CMIE, national unemployment rate has climbed to 7.97% in April, and it was 6.5% in March, and approximately 73 lakh people have lost their jobs, and it is very difficult to lead the life by the migrant laborers or the daily workers who cannot get the work on daily basis. That's why they are moving back to their villages. So in this kind of situation, we have to be very careful with what we do with our current incomes and our savings. So that is why we have to understand this subject, and also it is, I mean, if you are stepping out of your college life and stepping into your professional or practical life, this subject is going to help you. It is very useful for those who want to enter into corporate world, who wants to be a portfolio manager or investment manager. For them, it's going to be a lot of help. So, with that said, let's get started with our today's content. Today, I'm going to talk about the meaning and definition of investment and investing, nature of investment analysis or investment management, objectives of investment, scope of investment management. So let's get started with the meaning of investment. So, investment is an asset or items acquired with the goal of generating income or capital appreciation. So what does this mean is, it is nothing but acquisition of an asset or an item with the purpose of generating income or capital appreciation. As you might have experienced, that sometimes we have incomes which are in excess of our expenditure, and sometimes we fall short of the income due to our excessive purchasing or excessive acquisition of things or items. So what happens, sometimes we fall short of the amount, and sometimes we are having excess of the amount compared to our expenditures. So at that time, what we do, we keep that amount aside. So whatever income we generate, if we save something from that, if we are having excess of the income remaining with us, what we will do, either we will keep it in our cupboard, or we will be uh, keeping it in a pot and dig a hole in the land and bury it. Is that the situation? No, because if you do that, whenever you go to the cupboard and take back that money, the same money you will be getting. But what happens in today's situation, how in fact this is the reason for the establishment of banks, because first, in the earlier days, what used to happen, people used to dig up a particular hole in the land, or particular, I mean, pit in the land, and they used to bury whatever wealth they had, and whenever they wanted it back, they used to dig it up and open it and use it. But after that, what happened, they started giving that amount to the priests in the temples. So we can see the examples of temples in Barcelona, and we have the examples of Venice. So after that, what happened? People started uh, losing their trust on the people in temples and all. That's why what they did is they used to uh, put their money with the money lenders, what we call them as big businessmen. What they used to do, they used to take their money, use them in their businesses, and give extra amount along with the investment, along with the amount given by the saver. They used to put some interest in it, and they used to give it back. That's how the concept of bank came into existence. So investment is nothing but putting your money in such an item that it is going to give you extra income. So we can say that money makes more money. So if you just keep your money inside your pillow, or if you keep it in your cupboard, what you will get after duration of time, you will get the same money. But when you are going to put it in some beneficial alternatives or avenues, you are going to get extra money or generate extra income. So here the investment is nothing but acquisition of that asset or item with the goal of generating income or capital appreciation. So as the word goes, money makes more money. When you are going to put your money in such a asset or such an item that can lead to regular income or capital appreciation, so that process is called as investment. In economic sense, an investment is the purchase of goods which are not consumed today but are used in future to create wealth. So, from the point of view of economics, we can define, or we can give the meaning to the investment as purchase of goods which are not used today. So we are saying that we are purchasing those goods which we are not going to use today, but we are using it in future to create wealth. We are using that asset for creating wealth in the future. It is nothing but putting your money in such a way that it is going to generate more and more money. In finance, an investment is a monetary asset purchased with an idea that the asset will provide income in future or will later be sold at a higher price for a profit. That is what income and capital appreciation is. So from the finance point of view, investment is a monetary asset or purchase of a monetary asset uh, with the idea that that asset will provide income. So here we can see two concepts. One is income, another one is capital appreciation. So you can generate more income in the form of regular returns, or you can have capital appreciation. That is nothing but if you have purchased one asset at a cost of 50 rupees today, at a later point of time you will be able to sell it at 100 rupees of value. So this is what called as capital appreciation. This happens in case of real estate. If you purchase a plot of land today, you will be able to sell that plot of land at a higher price after a duration of time, after say 1 year or 2 year. So that is what investment stands for. Or along with that, you can also have regular incomes. If you invest in say for example mutual funds, you will be having different categories of returns on it. They have periodical returns, so monthly returns, and you may get, or you may get yearly rate of returns. So either you will be able to generate periodical returns or incomes, or you will be able to generate capital appreciation. So that is what investment is. So it is employment of funds on asset with the aim of earning or capital appreciation. As I've already said, you are going to put your money in such an asset that it is going to give you a return, or it is going to give you capital appreciation. Capital appreciation is nothing but the increase in the value of that asset which you will be able to realize after a period of time. So in simple, if I say investment is nothing but acquisition of an asset which is going to generate income or capital appreciation. The process of investment is nothing but the process of purchasing. Investment, we can call it as an asset or an item, or also the process of investing in that asset. Investment can be called as asset or an item in which you have invested, or investment can also be called as a process of investing in that asset. So Fisher and Jordan has defined investment as commitment of funds made in the expectation of some positive rate of return. So we are committing our funds, we are committing our savings in such a way that it is going to give us a positive rate of return. So it's nothing but putting your money in such items which is going to give you more money. So let's talk about the nature of investment management. So management helps in making investment decisions. So as you can see, here we are going to understand whether which kind of security we have to invest in, which kind of company we have to invest in, or whether we have to invest or not, or what we have to do with our money. So investment management is going to help us in making such investment decisions. Then it also helps in evaluation of securities. As we go on studying in this particular subject in the further coming units, where we have to carry on the fundamental analysis or the technical analysis, where we are going to study the economy or the industry and the company and the securities of different companies. So it also helps the investor in evaluating the securities, finding out the rate of return from different securities, finding out the risk attached to those securities, and all that investment management is going to help us. The third point is measures risk and return. As I've already said, here we are going to apply some models, some equations, where we are going to find out the risk and return relating to one particular security or a group of securities, or nothing but the portfolio of the securities. Then we have the benefit of predicting future performance. So investment management also have the ability to predict what will be happening in the future. Like we have different charts here. We are going to use different charts for finding out what will be the growth rate in the rate of return, or what will be the what we call whether the particular company is going to perform well or not. So we will be having different methods and techniques by which we are going to predict the future performance of the selected company. The last point is suits investors need. As I've already said, because investment management helps in all these items, it helps the investor in finding out where to invest, when to invest, and what how much to invest, and in which country to invest, which industry to invest in, and what will be the risk and returns relating to that particular security which you have already selected, and predicting whether it is going to perform well or not, all that. So investment management is going to help in these types of questions which are encountered by an investor. So this is the nature of investment management. And then we have the objectives of investment. Why we invest? What is the reason for investing? As I've already said, future is uncertain. We cannot predict what is going to happen in the future. What is who is going to have who is going to become rich, and who is going to go from rich to rags, or who is going to jump from rags to riches. Okay, so the first point is generating income. As I've already said, income is nothing but periodical returns, we can call it as. The main and foremost objective of investment is generating income, making more money from the existing money. So for in generating income, we can invest in different alternatives that we are going to understand in the upcoming sessions. There are a lot of avenues or alternatives where you can invest. For example, you can invest in mutual funds, you can invest in real estate, you can invest in equity shares, etc. The next objective is capital appreciation. So here we can say that capital appreciation is nothing but the ability to sell your product at a higher price in the upcoming future. So as I've already explained, in case of real estate, what will happen if you purchase a plot of land today, you will be able to sell it at a higher price in the future. So that is what capital appreciation is. Here we can see three types of capital appreciation. Either it can be conservative growth, or it can be aggressive growth, or it may be speculation as well, where we are going to have short-term incomes. So this is what the another objective of investment is. The third objective is safety and security of the funds. So we are going to evaluate different avenues, and we are going to find out in which avenue we are going to invest, and then we will be evaluating which avenue is safe and secure for our funds. For example, If you put your money in equity shares, which is very volatile market, then the security or the safety of your investment cannot be assured for a short period. If you invest for a longer period, then can have a particular rate of assurance. But if you invest in equity shares for a short period, we cannot assure whether you are going to earn positive returns or you are going to lose your money. So in contrary to that, we can invest in fixed deposit, which is a safe and the secure uh, avenue of investment, where you can put your money for 1 year or 2 year with a certain rate of return. So for example, 5% is the fixed deposit rate of return in SBI banks, I mean in nationalized banks in India. Whereas you can invest in fixed deposits of other private banks or any other avenues which are safe in nature. So fixed deposit is one of the safest of the investment avenue, I can say. So we are going to have a security and safety to our funds. So this is the third objective of investment. Suppose if you do not invest in any of these avenues, what will happen? You may lose that money by theft, or you may spend that money excessively without any necessity. You are going to waste all that money. That is why we need to invest to make our product, to make our money safe, to keep our money safe and secure. The third objective is liquidity. Liquidity is nothing but the ability of an asset to be converted into cash. So you have already got the idea what liquidity means. It is nothing but the ability of an asset to be converted into cash. So whenever you are going to invest your money, we will be evaluating the liquidity of that avenue. So if you invest in a 1 year fixed deposit or 5 year tax saving deposit, what will happen? You cannot get that money converted into cash unless the maturity period is over. So so keeping your money in liquid form is also important, because whenever the contingency arises, we will be able to convert that asset into uh, cash, and we will be able to use that asset. So making your money liquid, or making your savings and keeping them into liquid form, not just the cash form. We can put them into savings account, or we can put them into a short term treasury bills, like 14 days treasury bills and all that, so that we can easily convert them into cash whenever the need arises. So that is also one of the objectives of investment. The next one is tax consideration. As you know, the income from capital gains is one of the sources of income for calculation of income tax or wealth tax, we can say, for that concern. Capital gains are taxable under the Income Tax Act 1962. So we have to be very careful. We have to have a particular balance between how much we invest and how much we are going to spend, so that we are going to pay a considerable rate of a considerable amount of income tax, so that we are not going to waste our money in the form of income tax, by payment of income tax. So here what happens, some people invest in order to avoid the taxes. So for example, we have tax saving 5 years deposits, we have national security certificate, national savings certificate, nst certificates. We can invest in nps for the employees, for the salaried people. We have nps, we have kgid. You can also invest in lics in order to avoid taxes. So our tax consideration is also one of the objectives of the investment, where we are going to invest in order to minimize our tax burden. So that's what another objective of investment is. The last point is hedging against the inflation. As you know, inflation is nothing but increase in the purchasing power. Just a second. Inflation is the increase in the rates in the market, I can say it like that. What happens whenever supply of money increases in the market, whenever we have excess of supply of money in the market, what happens? The purchasing power of that particular money is going to go down. We can say that uh, whenever we are supplied with a huge amount of money in the overall market, what will happen? So for example, 1 rupee which can purchase 1 pen today will not be the same in upcoming future. What will happen, you might have observed this, whatever commodities, whatever goods you used to purchase in 100 rupees 10 years back is not the same today. So that is what inflation is. So approximately in India, the inflation rate is in this 2020, it is approximately 6 point something, ranges from 6 to 7%. Inflation, higher inflation rate is also not important. So we can say that in 100 rupees which you used to spend 10 years back, whatever item you used to purchase is not the same today. You can purchase fewer items from that 100 rupees. So what will happen, money will lose its purchasing capacity, or purchasing power will be minimized due to the inflation rate. So in order to hedge from inflation, so hedging is nothing but creating a bond. You might have seen in the form of a paddy, in paddy farms, the one which grow rice. So you might have seen in those type of forms, they create boundary on their plot of the land on which they grow uh, paddy, so that the excess water, I mean the water does not get overflowed. So in order to stop the water from flowing, they will create a bond, or a partition which is going to control that water. That is where the word hedge comes from. So hedging from inflation is nothing but protecting you from losing the purchasing power of your money. So if we invest in some alternatives, what will happen, we will be earning some returns on that, so that we can cope up with the inflation rate. So whenever we are going to invest, we need to remember our rate of return from the investment should always be greater from the rate of inflation. Suppose approximately 7% is the inflation rate. If we invest in 8 to 9% of the if we invest in such securities which can fetch us approximately 8 to 9% of the return, that is going to be beneficial. Otherwise it is not going to give our I mean it is not going to preserve the purchasing power of our money which we have invested. So whenever we are going to invest, we have to remember that our rate of return from that investment should always be greater than the inflation. So in order to secure, or in order to preserve the purchasing power of our money, we have to invest. So that is also one of the objectives of investment. And the scope is nothing but what we are going to study in a particular subject, or on a particular topic. So here we are going to study about investment management. So the scope of investment management is identification of investors requirement. Here we are going to understand what an investor want, whether he want a periodical return, or he want a capital appreciation, whether he want a quick return, or whether he can hold for a longer period. So we are going to evaluate what an investor wants to have. So after that, we are going to formulate the investment policy or the strategy. So here we are going to first evaluate what an investor wants, and as per his needs and requirements, we are going to evaluate a particular investment strategy where it is going to best suit the needs of the investor. Then we are going to execute the strategy. For example, if an investor wants safe return, and he is ready to hold for a longer period, then we can invest in either mutual funds, or we can invest in I mean fixed deposits. He wants safety of the investment. If the requirement of the investor is safety, then we can invest in mutual funds or fixed deposit. Suppose an investor is interested in earning higher rate of return and ready to take high risk, we can invest in equity shares, which are going to fetch you approximately 11 to 12% of the return, whereas fixed deposits and mutual funds are going to fetch you 5 to 6%, or mutual fund are going to fetch you 8 to 9% of the annual return. So we are going to first identify what is the need of the investor, whether he is ready to take the risk or he is a risk averse or he is avoiding the risk. So after that we are going to select this strategy, or we are going to formulate this strategy. Suppose the investor is a risk averse who want to avoid the risk, we will invest in mutual funds or fixed deposits. Suppose the investor is a risk taker, we will be investing in the equity shares. Then we are going to execute that strategy. Putting our plans into action is called as execution. So whenever when we are going to invest, actually that is called as execution of the security. And finally we are going to monitor our portfolio. We are going to keep on evaluating, keep on revising as per the changing needs of the investor, as per the market conditions, as per the rules and regulations. So this is what we are going to study, and this is what we are going to cover in investment management. Okay, so that's it for this session. In the next session we are going to be talking about the concepts of speculation, gambling, and features of uh, an optimal investment portfolio. So that's it for today. Thank you.